Property Insights, one topic, 20 minutes or less, 7 days a week. Myself, Lawrence Lotze, and today joined by Andrew Armstrong, a mortgage specialist and a fellow property investor. And today, AJ, I've got a question. It's something that I'm intrigued about, and it's fundamentally, if I've hit my LVR restrictions, so the LVR is loan to value ratio that banks put on you of how much money you can lend, whether it's your personal home or investment property. If I've hit that barrier and I need to extract more funding, whether it could be because I want to do a home renovation or I want to develop or want to do something else, what are my options to be able to get funding out of the bank when I've hit that barrier?
Okay. All right. Interesting question. It's something that does pop up from time to time. And typically it goes along the lines of, hey, I've got this property, I've got my investment property, for example. Lots of investors go, hey, look, I'm at 60% LVR. I've put in 40% to buy this property, but now I need to go through and put it up to healthy homes, or I just need to make it a bit better because I'm going to increase the rent. For example, I've got tenants coming in. How do I do it? That's one. And then I'll come back to a little more further in depth where they want to sort of add another story or another room. But what both of them entail is where we go to the bank and go, hey, look, this is a customer situation. This is how much they want to spend. But once they've spent it, it's going to be worth, what they've spent plus another, 10% on the value of that property, say, or 5%, or whatever it's worth. So what we need to do is find out what the details are, what the facts, figures, how much it's going to cost, and then go to the bank and go, hey, will you give me money on the basis that this is what it costs, this is what I need, and the future value is, another 5% higher. And the bank goes, yep, cool, happy with that. We go and then order a valuation on behalf of the customer, get a valuer in there just to confirm that, yes, indeed, if you go and spend this much money, this is what the anticipated future value is. So pretty straightforward. Obviously, you've got to provide and pay for the valuation up front, know your figures, know your quotes, and make sure you've got enough money. But definitely a process that you can do, that we can do. You can approach the bank, we can approach the bank for our guys. Recently last year, it's nearly finished, but it was a major renovation. So one of our customers has said, hey, AJ, we want to replace all the external cladding. We want to reline the entire house. We want to move some walls. We want to double glaze. We really want to go to town on this house. Great location, just outside of Auckland. And we went through that process. We said, hey, what's it going to cost? He said $250,000. At that stage, he was sitting at about 75% LVR, so there wasn't enough equity as it stood on the value of the property. But what we did, the ultimate result was, went to the bank. He could afford it for the entire loan. And we got a valuer out there who confirmed that, yes, if you spent $250,000, the house will go up by $300,000. And the bank approved him and drew down the loan on a basically construction base on a construction basis. So we sent them invoices for the work completed, and the bank paid out there. Ultimately, the final result was that the property went up further than what he'd spent, than the value had said, and now he's got even more equity in effectively a fully renovated house. So,
no, that's great to hear, AJ. So fundamentally, as long as you can show to the bank that if you give me more money, this money will have its value in the future equity in the property. It doesn't mean that's always going to happen. So me throwing paint on a house doesn't mean it's naturally going to value up. Me changing some of the taps or the lighting might not. In some instances, if you're flipping properties, it might, but it might not do that. So when you hit that threshold from your LVR, you do have the possibility, but you have to be able to show the increased value at the end of it to the bank up front to be able to get that.
Yeah, that's right. You have to sort of make sure that what you're planning to do is quite realistic and you're not going to blow out the budget. Otherwise, the bank will kindly ask you to come up with your own money to fund it, and worry about it then.
Awesome. Thanks, AJ. And to anyone else that's listening or watching, if you have any questions for myself or Andrew, the details will be in the description, depending where you're listening or watching. And thanks for coming over to the Daily Nugget, Daily Property Insight, one question, 20 minutes or less, 7 days a week. And I hope to see you tomorrow.